Welcome to our Videocast series, sponsored by the Society of Actuaries Center of Actuarial Excellence, CAE grant entitled Integrated Risk Management in a Changing World with Application in Insurance Enterprises. My name is Ken Sing Tan, a professor in actuarial science in the Department of Statistics and Actuarial Science at the University of Waterloo. The title of this videocast is on risk measure-based reinsurance model. In this presentation, we provide a basic understanding of using reinsurance strategy as a risk management tool for insurance company. By formulating as an optimization problem, we demonstrate that any desirable feature, including the company's risk appetite, profitability, can be incorporated into the optimal reinsurance model. In particular, we also highlight more advanced risk measures such as value at risk, continuity expectation, can be exploited to determine an optimal reinsurance strategy for the insurance company. To accomplish this presentation consists of three parts. First, we provide a brief introduction on reinsurance. Then, we demonstrate why it is important to formulate the problem as an optimization problem. Finally, we provide an intricate role between the optimal reinsurance strategy and the risk measure, along with some of our key findings in this research. So to begin, let us consider a standard arrangement between policyholder and the insurance company. So in this diagram, there are two players in the market. On the left-hand side, we have the policyholder, and on the right-hand side, we have the insurance company or the insurer. In this case, the policyholder in this case are interested in transfer some of their risk to the insurance company. For example, the policyholder may have just acquired a car, so is concerned about the potential damages to the car or the liability associated with a car accident. And as a result of that, the policyholder is interested in transferring some of the risk to the insurance company. To do that, there is a cost to the policyholder in the form of insurance premium. The insurance company, on the other hand, by accepting the insurance premium, there is an obligation in the future. In particular, if there is any claim arising, or if there are any damages to the policyholder's car, for example, the insurance company will be indemnified the losses to the policyholder. And they explain that there is another arrow from right to left, a transfer of the indemnity payments from the insurance company to the policyholder. So a key question in this case is that under what circumstances would the insurance company interested in reinsurance? Well, first of all, reinsurance is an insurance on insurance company. So to understand the situation where the insurance company will be interested in reinsurance its risk, let's assume that the insurance company has recently underwritten catastrophic risk, such as the earthquake risk. Earthquake risk is known to be a risk that is low frequency but high severity, which means when the earthquake strikes, the potential losses is huge. Because of the large catastrophic risk, the insurance company may not be able to sustain such a event. So in order to transfer some of this risk to the reinsurance company, reinsurance can be a viable solution. And the second reason why insurance company is interested in reinsurance is that because of the potential risk reduction by using the reinsurance, the solvency capital of the insurance company can also be reduced in turn. Similarly, because of the presence of the reinsurance, the insurance company is in a position to accept more risk or underwrite more businesses. Finally, the availability of reinsurance expertise. This is actually a very interesting application in the following sense. Well, let's suppose that an insurance company traditionally has been underwriting car insurance. And suppose that the insurance company is willing to expand their business to, let's say, home insurance. And assuming that the insurance company do not have the expertise or the experience in underwriting home insurance. So this is a situation where the insurance company can partner with the reinsurance company, where the reinsurance company tend to have a lot of expertise in this area, and hence, from the insurance company point of view, that a viable, home insurance contract or policy can be designed as a result of the partnership. So let us revisit these slides again, right? Recall that this is a diagram that demonstrates, the relationship between the policyholder and the insurance company. Now, because of the reinsurance policy, there is a third player in the market, which is known as the reinsurer. Similar to the relationship between the policyholder and the insurance company, in this case, there is also an exchange of cash flow between the insurance company and the reinsurer. For example, denoted by F at X, which is known as the ceded loss function or the indemnity function. So this function F dictates or measures the amount of losses that is being transferred from the insurance company to the reinsurer. Which means that in the future, if there are any claim arising, the insurance company is responsible to indemnify the insurance company of amounts given by F at X. Because of the risk transfer from the insurance company to the reinsurer, there is a cost to the insurance company. And this is denoted by the function pi, which is the insurance premium that will be charged by the reinsurance company. Right? Note that the amount of premium charged, it will be a function of how much risk is being ceded to the insurance company or to the reinsurance company. Next, let us consider how do we determine the reinsurance premium. In many cases, this is determined by the so-called premium principle. And here, I will just list two of the most standard premium principle, known as the expected premium principle and the standard deviation premium principle. For the expected premium principle, essentially is proportional to the expected payout. Note that data is greater than 0. This is known as the safety loading factor to reflect the administration cost, the profitability of the insurance company. For the standard deviation premium principle, it consists of two components. The first component is the expected payout. The second component is the square root of the variance of the ceded risk. Note that in this case here, data is positive. So which means that in both of these premium principle, the amount of the premium charge is higher than the expected payout. An important distinction between the expected premium principle and the standard deviation principle is in the sense that in the latter case, it actually takes into account the availability of the risk as reflected in the standard deviation of the risk itself. And the last point that I like to emphasize here is that the premium that is charged should increases with the risk that is ceded or that is transferred. Again, this is not surprising because the higher risk that you're willing to transfer to a reinsurance company, you expect to pay a higher premium. This diagram demonstrates that in practice, there are a number of ceded loss function. On the far left, on the upper left corner, so this is an example of the so-called quarter share reinsurance, or in other words, it's a proportional reinsurance. And basically what this means is that, depending on the ratio A, which is between 0 and 1, that the insurance company and the reinsurance company share proportionally depending on the proportion A. On the upper right corner, so this is an example of the stop loss reinsurance. Again, this is another very common reinsurance treaty. Well, we say that for losses that is less than D, which is a retention level, the amount that will be paid or indemnified by the reinsurance company is 0. If anything above D, which is the retention level, then there will be a reimbursement of losses from the reinsurance company to the insurance company of amount equal to X minus D. Another important feature of this stop-loss reinsurance is that from the point of view of the reinsurance company, the insured risk is unlimited, right? In the sense that there is no upper bound. This, to some reinsurance company, may not be desirable, and hence there is a third form of zero loss function, which is known as the limited stop-loss reinsurance. This zero loss function is very similar to the stop-loss, except it says that if the losses exceed a certain level, which in this example is given by M plus D, then the reinsurer is only responsible to a maximum amount given by M. So which means here, the indemnity amount, there is a cap on the indemnity amount. Finally, the truncated stop-loss reinsurance. So this has a very peculiar shape in the sense that for any amount less than M, it looks like a stop-loss. But anything beyond that, it immediately drops drastically to 0. So which means for any losses greater than M, there is no indemnity payment. From the insurance company point of view, by engaging in a reinsurance strategy is essentially to partition the risk into two parts. Recall that X represents the aggregates of the risk initially insured by the insurance company in the absence of reinsurance. In the presence of reinsurance, then part of this X will be ceded to the reinsurance company. How much is ceded? This is captured by the notation F at X. So which means that how much is being retained by the insurance company, which is given by X minus F at X. Here we use the notation R to denote the retained loss. Right? This diagram also indicates that there is a trade-off between risk retention and risk transfer. Why? Well, recall that F at X refers to the amount of risk that is being transferred, that is being ceded to a reinsurance company. In exchange of that, the insurance company is also liable to pay an amount given by the pi, which is a function of F at X, which is the reinsurance premium. That pi function increases with the amount of risk that is being ceded. So what this means is that from the insurance company point of view, if the insurance company is being very conservative, would like to transfer as much risk as possible to the reinsurance company. This can only be achieved at the expense of a higher reinsurance premium. Right? On the other hand, the insurance company can be more aggressive. They can retain most of the risk. If they do that, then they will have substantial saving in the reinsurance premium by paying less to the insurance by paying less to the reinsurance company. Right? So this illustrates a trade-off between risk retention and risk transfer. So an interesting question, because of this trade-off, an interesting question is what is the right balance between risk retention and risk transfer? Mathematically, this implies that this problem can be formulated as an optimization problem, or more specifically, can be formulated as an optimal reinsurance problem. Right? So to proceed, that if we were to view this as the optimization problem, then we do have to make decision on a number of considerations. First, what would be the appropriate objective? Right? Second, what is the assumption that you're going to make on the Sealer loss function? Third, how would the premium be determined? And finally, there could be some other desirable constraint that you like to impose. For example, you want to make sure that you're still able to make some profits, or you still want to reflect your insurance risk appetite, for example. In the literature, there are two classic optimal reinsurance models. This goes back to in the early 60s. For example, the work by Borch that basically says that the objective here is to minimize the variance of the retained risk while assuming the expected premium principle. In 1963, Arrow also proposed another optimization model, and rather than minimize the variance of the retained risk, in Arrow's model, he proposed to maximize the expected utility of the terminal wealth. Interestingly, that both of these models, or both of these optimizations, says that under this formulation, stop-loss reinsurance is optimal. All right? And this in part also explains that in many of the literature, that stop-loss reinsurance has been the optimal strategy. But in our work, we are interested in consider a bit more sophisticated reinsurance model. In particular, we are interested in tying risk measure to the reinsurance model. So let us now consider this, introduce this notation called T at X. Suppose T represents the total risk exposure of the insurer in the presence of reinsurance. As you can see from this equation, it comprises of, it's a sum of two components. The first component is the amount of risk that is being retained. And second component is the reinsurance premium that is paid to the reinsurer. Note that this total risk exposure notation is a function of the Sealer loss function. Right? What this means is that if more of the risk is being ceded to the insurance company or to the reinsurance company, the retained risk will be smaller, but at the expense of a higher reinsurance premium. Okay? On the other hand, if the amount of risk that is being ceded to the reinsurance company is less, which means that the pie is small, but this will be achieved at the expense of a higher retained risk. So this again demonstrates the trade-off that we discussed earlier. Note that as a comparison, in the absence of reinsurance, the insurer's total risk exposure is just simply given by X. Given this notation, a plausible risk measure-based optimal reinsurance model can be formulated as follows. If I denote rho as an appropriate chosen risk measure, and C is a set of admissible Sealer loss function, then a plausible model is as follows. Given a risk measure, my objective now is to minimize this total risk exposure. And this minimization is taken over the feasible Sealer loss function, depending on how we specify C, and subject to a chosen premium principle. The complexity of this model obviously depends on what kind of risk measure that you use, what is your feasible set and also what is your assumed premium principal. Just want to illustrate a very simple model that's a work that we did in 2007. So in this paper, we make 3 very simplifying assumptions. First, we immediately assume that C, the serial loss function, is simply a stop-loss reinsurance. So which means that, here it becomes that what would be the appropriate value of D. Okay. Second, we assume that in terms of premium principal, we assume that it's the expected premium principal. Finally, that in terms of the risk measure, the paper considered that it can either be a value at risk or a conditional tail expectation, or simply the conditional value at risk. Again, a quick review on the difference between VAR and CTE. As you probably know, that VAR essentially is a quantile risk measure. Right? For example, if alpha in this diagram represents, let's say, 99%, VAR simply represents the 99% quantile. On the other hand, CTE measures the expected losses or the expected shortfall given that the losses exceed the VAR value. So essentially, the diagram here, the area that is shaded red color, so that would represent the expected shortfall. So both of these risk measures, are extremely popular in insurance company and in banks as well. Under this assumption, then in this paper we consider 2 risk measure-based optimal reinsurance model. The first one is based on the value at risk, and the second one is based on the CTE. So as you can see here, that the objective becomes a very simple, a very straightforward, one parameter optimization problem. The only uncertainty or the only unknown in this optimization problem, or the decision variable, is given by this parameter D. Again, D represents the retention level of the serial loss function or the stop-loss reinsurance policy. And we showed that if optimal retention exists, it turned out that the optimal retention value is given by has a very simple solution, as given by the inverse of this survival function. And this result is interesting and to some extent quite intuitive. Well, first of all, this result says that regardless of whether you use value at risk or CTE as the relevant risk measure, both of these risk measures consistently giving the same answer. Second, it's quite intuitive in the following sense. If data go to 0, the retention level also go to 0. Again, recall what data represents. Right? So data represents the safety loading. If data is 0, so which means that the reinsurance premium is equal to the expected payout. So in this case, this represents that a situation that the reinsurance is relatively cheap, and hence the insurance company is willing to transfer all the risk to the reinsurance company. And hence, this will represent a case with full reinsurance. On the other hand, if data goes to infinity, which means this is for the insurance company to reinsure its risk, it's getting more and more expensive. And if that's the case, then the insurance company will retain all the risk. So which means there is no reinsurance. While this paper was the first paper, essentially was the first paper that talked about how to integrate risk measure to the reinsurance model. But this paper has been generalized in a number of directions to produce a more sophisticated and more realistic optimal reinsurance models. Some of these generalizations are reflected in a more appropriate objective function. Right? Again, recall that in our original paper, we only look at minimizing VAR or CTE. Here, we can also integrate, for example, how to maximize the risk-adjusted return, for example. Premium principle. In most literature, standard deviation is most commonly used. But in our subsequent work, we have extended this to include other premium principle, including, for example, Wang's premium principle, the distortion principle, and so on. Right. Finally, the cedar loss function. Again, in the original paper, we immediately assumed that the optimal cedar loss function is a stop loss. And again, in practice, we don't have to make that assumption. So this extension has been summarized in this work that is being supported by the CAE grant. Right? And because of the complexity of this model, so in this videocast, we will not go into details, but we encourage the viewer to look at this report. But once the important finding in this work are as follows. Depending on how we define the optimization problem, depending on how we assume for the premium principle, and what kind of assumption that we make on the cedar loss function, in our work, we have demonstrated that stop loss is not always optimal. In fact, we have shown that proportional can be optimal, or the stop loss can be optimal, or even the limited stop loss and the truncated stop loss can also be optimal. Again, all this depending on how you formulate the optimization problem. The fact that truncated stop loss can be optimal also raises a very interesting issue. For example, imagine that this is the kind of cedar loss function that is being underwritten. In general, a truncated stop loss reinsurance is considered undesirable because it will promote or encourage moral hazard. Right? To see that, imagine that, let's say supposedly for the reported losses. Under this reinsurance cover, it says that if the losses is slightly smaller than M, then there is an indemnity from the reinsurance company. If the incurred losses is slightly larger than M, the indemnity payment immediately drops to 0. So this peculiar feature will encourage moral hazard in a sense that it will encourage the insurance company to underreport risk. Right? Knowing that if the reported risk is slightly less than M, there will be an indemnity payment. But if the reported loss is higher than M, then there will be 0 indemnity payment. So these results also indicate that the importance of imposing the right constraint on the cedar loss function. So generally, that in the literature on optimal reinsurance literature, it is important that for the cedar loss function, it should be non-decreasing in order to alleviate or reduce the moral hazard. Right? So with this also concludes our videocast. And again, thank you for your attention.